Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, what are the strategies for intraday options trading? Answer by Vijay Sachdev. There are many intraday options strategies which may give good results, but you should always keep in mind that options are worth buying only when they have least premium. Giving high premiums is riskier and we can't generate good profits by giving high premiums. Now big question is how to buy with low premiums? Well, we have to wait for that because options doesn't give daily opportunities. We have to wait like lion wait for its hunt and gather food of whole weekend. A single hunt. Options premiums are less when expiry is near, and I prefer Bank Nifty options over other options like stocks or Nifty because Bank Nifty has weekly expiry, so we get more opportunities. When we trade on Wednesday or Thursday, we get options with very low premium and they have higher probability to generate good profit. Options trading is best trading for those who want to multiply their capital and want to take limited risk because options is the only segment which can give huge returns with calculated risk. I mostly trade in Bank Nifty options on advice at www.equitix.in because Bank Nifty has weekly expiry, which is biggest advantage in options segment. We can save premium and get very good profit in options when we are trading in Bank Nifty weekly. I am giving example of yesterday, August 3, 2018, where I booked huge profit in small investment on Bank Nifty expiry day. I bought Bank Nifty 24,300 CE, August 3, 2018 expiry, at 15.50, 1,480 quantity, and booked at 75.50 in intraday only, which was 88,800 profit. Almost 600% returns in intraday with small investment is possible in options only. You can adopt two things from this trade. First thing is when they suggested to buy 24,300 CE at Bank Nifty at 15. Bank Nifty price was 24,160 and it was oversold, so bounce back was expected and maximum risk was 15 rupees only, which was calculated risk. Second thing, Bank Nifty and Nifty was near support and did not break yesterday's low, so it was clear sign of recovery today. So risk-reward ratio was higher. When we are buying option at 15 only on expiry day, risk is just 15 rupees only and it became 215 in intraday, which was huge surge in intraday. So ultimately my trading strategy in options is very simple, that I follow Equitix trades only and I don't trade regularly but trade only when expiry is near so that risk can be minimized and we get huge profits. These things I learned from Equitix Global Research, which is providing good knowledge and arranging training workshops to spread knowledge about trading. My previous answer on options trading. Vijay Sachdev's answer to is options trading more profitable than equity cash? Vijay Sachdev's answer to what are some options strategies with small investments and high profits? What is the risk-reward ratio in this case? Vijay Sachdev's answer to which website has the best options trading advisory service? Answer by Raynor-Teo. The accumulation phase where trend traders get killed. The advance phase which trend traders love. The distribution phase where trend traders get killed. Again, the declining phase where traders turn into investors. The best trading strategy for different market conditions, allowing you to increase your winning rate. The worst trading strategy for trend and range markets so you can avoid losing your hard-earned money. It usually occurs when prices have fallen over the last 6 months or more. It can last anywhere from months to even years. It looks like long period of consolidation during a downtrend. Prices contained within a range as bulls and bears are in equilibrium. The ratio of up days to down days are pretty much equal. The 200-day moving average tends to flatten out after a price decline. Price tends to whip back and forth around the 200-day moving average. Volatility tends to be low due to the lack of interest. It usually occurs after price breaks out of accumulation phase. It can last anywhere from months to even years. Price forms a series of higher highs and higher lows. Price is trading higher over time. There are more up days than down days. Short-term moving averages are above long-term moving averages, e.g. 50 above 200-day MA. The 200-day moving average is pointing higher. Price is above the 200-day moving average. Volatility tends to be high at the late stage of advancing phase due to strong interest. Moving average. Support area. Previous resistance turns support. Fibonacci levels. Breaks above swing high. Close above swing high. It usually occurs when prices have risen over the last 6 months or more. It can last anywhere from months to even years. It looks like long period of consolidation during an uptrend. Prices is contained within a range as bulls and bears are in equilibrium. The ratio of up days to down days are pretty much equal. The 200-day moving average tends to flatten out after a price decline. Price tends to whip back and forth around the 200-day moving average. Volatility tends to be high because it has captured the attention of most traders. It usually occurs after price breaks out of distribution phase. It can last anywhere from months to even years. Price forms a series of lower highs and lower lows. Price is trading lower over time. There are more down days than up days. Short-term moving averages are below long-term moving averages, e.g. 50 below 200-day MA. The 200-day moving average is pointing lower. Price is below the 200-day moving average. Volatility tends to be high due to panic and fear in the markets. Moving average. Support area. Previous resistance turns support. Fibonacci levels. Breaks above swing high. Close above swing high. Answer by Surya Kamal. This is one simple trading strategy for beginners which I came across in recent times. This strategy can be traded on any given time frame. This can be used for swing trading, day trading. This strategy can be traded with any market, such as stocks, futures, and forex. To trade this strategy, the following indicators are used: 20-period simple moving average, 40-period simple moving average, 80-period simple moving average. Step 1. Apply above indicators to chart. Apply all of the above 3 moving averages to your chart like this. These are 20, 40, 80-period simple moving averages. Step 2. The trend. Up or down? Once your 3 indicators are on your chart, go ahead and find a current uptrend or downtrend. To do that, simply look at where the price action is and determine if it's above the moving averages or below. If the price is above the 3 moving averages, you have an uptrend. Step 3. Wait for entire candle to close outside of moving averages plus pull back in price action plus continuation of trend. Wait for the price close above highest moving average in an uptrend. Wait for the price close below lowest moving average in a downtrend. Once you see this occur, you wait for the price to pull back and then move in the direction of the trend to make your entry. To determine this, you can either go to a lower time frame or stay in the current time frame that the entire candle closed completely below or above the moving averages. The price action does not have to necessarily go back and touch the moving averages, which does occur, but you need to confirm there was pullback in the price and then a continuation of the current trend. In the example below, you can see that the entire candle closed above all 3 of the moving averages, pulled back in price action, and then continued upward. See below where you could have entered this trade. This was the bullish candle after a candle closed bearish. Stop loss. Place your stop loss below the bottom moving average line. Depending on what time frame you are in will vary on how large your stop is. Profit booking. Book profit is when the price touches the 80-period line. We at Return Wealth provides algorithmic trading services to clients such as working professionals, HNIs, and retail investors who do not have much time to spend before the live markets. Our algo platform analyzes Indian markets based on statistical and quantitative data and make trades automatically into customers' account. So it's not necessary for the customer to spend time and analyze markets. Instead, our algorithm will do the analysis and trade wisely for customers. For more details, visit www.returnwealth.com. Source: www.google.com. Cheers. Surya. www.returnwealth.com.